Taxes. Taxes are money collected by the government from what you earn, buy, own, or profit from. Look at your paycheck. You earned $2,000, but only $1,456 reached your bank account. The rest may have gone toward federal income tax, state tax, Social Security, and Medicare. Income tax applies to earnings. Sales tax is added when you buy something. Capital gains tax may apply when an investment is sold for a profit. Payroll taxes help fund programs such as Social Security and Medicare. That money also helps pay for roads, schools, emergency services, and other public programs. The amount withheld from your paycheck is an estimate. When you file a tax return, you compare what you already paid with what you actually owed. Pay too much, and you may receive a refund. Pay too little, and you owe the difference. A tax refund isn't free money. It usually means the government held more of your money than necessary during the year. That's taxes. Money is collected from private activity to fund public spending. Before we continue, make sure to leave a like on the video and subscribe for more simple explanations. Banks. A bank doesn't simply place your deposit in a vault and leave it there. It records the money in your account, keeps enough liquidity to handle normal withdrawals, and uses part of its funding to make loans and hold other assets. Suppose you deposit $1,000. Your account still shows $1,000, but the bank may use its wider pool of deposits and funding to support a mortgage, car loan, or business loan. The bank earns money from the difference between what borrowers pay and what the bank pays depositors, along with fees and other services. So why use one? Convenience and security. A bank lets you receive payments, pay bills, transfer money, use a debit card, and avoid keeping your life savings in a shoebox. Eligible deposits at insured U.S. banks are also protected up to applicable limits. That means a bank failure doesn't automatically erase every customer's insured balance. A bank, then, is not just a storage company. It is a financial middleman connecting money that is available with people and businesses that want to borrow it. Interest is the price of using money over time. Borrow money and you usually pay interest. Save or lend money and you may earn it. Borrow $1,000 at 10% annual simple interest, and 1 year of interest would be $100. The calculation is based on the original amount. Compound interest works differently. Interest is added to the balance, and future interest is calculated on that larger number. That can help or hurt you. When an investment compounds, its gains can begin producing additional gains. Time becomes part of the growth process. When debt compounds, the balance can grow before you have paid off the original purchase. That cheap meal or impulse purchase becomes much more expensive when it sits on a high-interest credit card. Also pay attention to the difference between an interest rate and an APR. The interest rate is the basic borrowing cost. A PR is designed to reflect the annual cost more broadly and may include certain fees, depending on the product. The principle is simple. Interest rewards the person providing money and charges the person using it. Which side you're on makes a major difference. Inflation. Inflation is a general increase in prices over time. It does not mean every product becomes more expensive at the same speed. It means the overall purchasing power of money declines. A $5 bill remains a $5 bill. It simply buys less. Inflation can rise for several reasons. Demand may grow faster than businesses can supply products. Energy, labor, materials, or transportation may become more expensive. Supply disruptions may make goods harder to produce. Expectations can also influence wages, prices, and spending behavior. Moderate inflation is different from a sudden price surge. When inflation rises too quickly, household budgets get squeezed because wages and savings may not keep pace. Central banks often respond by raising interest rates. Higher rates make mortgages, car loans, credit cards, and business borrowing more expensive. That tends to reduce borrowing and spending, cooling demand. But the process has a cost. Slowing demand can also reduce hiring, investment, and economic growth. Inflation matters even when your account balance never falls. If your savings earn 1% while prices rise 3%, the number in the account increased, but its purchasing power declined. Inflation is not money disappearing. It is money buying less. Credit scores. A credit score is a numerical estimate of how reliably you have handled borrowed money. In the United States, commonly used consumer credit scores generally fall between 300 and 850. A higher score can make it easier to qualify for credit and may help you receive better terms. The exact formula depends on the scoring model, but several behaviors usually matter. Payment history matters because lenders want to know whether you pay on time. Credit utilization compares your credit card balances with your available limits. If your cards are close to maxed out, lenders may see greater risk. Account age matters because a longer history provides more evidence of your behavior. The types of credit you have, recent applications, and newly opened accounts may also affect the result. Your income is not the same thing as your credit score. A person with a modest income can maintain strong credit. A high earner can damage theirs by missing payments or mishandling accounts. A credit score also isn't a moral grade. It doesn't measure whether you're responsible in every part of life. It estimates lending risk from information in your credit history. The practical rules are not mysterious. Pay bills on time, keep revolving balances under control, avoid unnecessary applications, and check your credit reports for errors. Investing. Investing means using money to acquire an asset that may produce income or increase in value. Stocks represent ownership in companies. Bonds generally represent money lent to a government, company, or other issuer. Funds combine many investments into one product. Real estate provides ownership of property that may generate rent or appreciate. Each comes with risk. Stocks can fall, borrowers can default, property can lose value, or require expensive repairs. Even diversified funds fluctuate. Not investing also involves risk, but that statement needs context. Money required for rent, emergencies, or near-term expenses should not be treated the same as money intended for decades in the future. Cash offers stability and immediate access. Long-term investments offer growth potential, but can lose value, especially over shorter periods. The real decision is not safe versus risky. It is which risks fit the purpose and timeline of the money. An emergency fund has one job: be available. A retirement account has another: support spending many years from now. Time matters because long periods give compounding more opportunities to work and provide more time to recover from market declines. Starting earlier can reduce the amount someone must contribute later, but growth is never guaranteed. Diversification also matters. Owning one company makes your result heavily dependent on that company. Spreading money across many assets reduces the damage any single failure can cause, though it cannot eliminate market risk. Investing is not a shortcut to guaranteed wealth. It is a way of accepting calculated risk in pursuit of future growth. How the concepts connect. These ideas are not separate. Taxes affect how much of your income you keep. Banks move money between savers and borrowers. Interest determines what borrowing costs and what saving may earn. Inflation changes what that money can buy. Credit scores influence the terms on which you can borrow. Investing trades certainty today for the possibility of greater value tomorrow. Once you understand those connections, finance stops looking like a collection of random vocabulary. It becomes a system. Money comes in. Taxes reduce it. Banks hold and move it. Interest changes its value over time. Inflation changes its purchasing power. Credit affects the price of borrowing. Investing determines how some of it may be used for the future. You don't need to become a financial expert overnight. You need to understand what each part does and recognize when it is working for you or against you.